Before we start, and introduce yourself and me, I thought I'd do a quick little introduction of BasisPoint Insights. So, BasisPoint Insights is conceptualized as an institutional platform, for largely for consumption of insights, so to speak, by market players mainly, like banks, mutual funds, asset managers, FPIs, other large investors. So it's not really retail focused. So what we felt that maybe there was room for a show like this, because to be honest, we don't see something like this, and that's the reason why we called it Market Makers, where we actually talk to the movers and shakers of the market, if I may, and it is meant for consumption by guys who are equally movers and shakers. Uh, so having said that, you kind of selected yourself as our first guest. You're the Shah Rukh Khan for the Karan Johar show.
Selected myself. I was invited.
And no, but if I may, to use this opportunity to introduce you, which is that as the head of the second largest bank in the country, ICICI, and arguably the largest risk taker in the country, in terms of the markets that we operate in. I thought you would be ideal as far as the first for inaugurating this show, and hence you're here. So thanks for agreeing to come. Prasanna, of course, has like the common phrase of needs no introduction. Having spent I think 3 decades almost or more in the markets, with largely with the ICICI Group, with ISEC, we've been partners on several boards and several initiatives, including FIMNA, FEDI, some of the committees that Prasanna has been part of as well. Lots of stuff and lots of participation in market initiatives, which Prasanna has done. And with that introduction, a little bit of me. Normally, I am for the first time on this side of the interview table. That's good fun, Prasanna, because I'm out of the firing line, and very happy to start doing that with you. Spent a long time in markets, multinational and local banks, and principally in the markets business. Right now, having said so much about who this show is targeted at, it would be unfair to do such too long introductions, because notably traders and market players have very short attention spans. They don't look at big long shows. They don't read large articles.
We have already lost them, maybe.
So let's quickly dive into the subject at hand. Idea again in this show is to talk about the key markets for us. So FX, rates, and equities. Let's start with FX, which is occupying a lot of people's attention these days. And maybe we look at it, from one side, which is, what have we seen happening in FX? And let's start with USD, right? USD is the big so to say, elephant in the room. And what has happened? Do you think, Prasanna? We come to the questions. Do you think that the USD is now in a structurally weak kind of situation for a longish time? If so, follow-up question is, what does it imply for asset allocators and asset classes, and notably currencies as well? Global currencies. And thirdly, of course, what we cannot ignore, another elephant in the room, is what does it imply for what has been happening in Japan, Japan, JGBs, etc.
Yeah.
So your views, please.
So I think, Manoj, it's a fabulous question to start off the conversation with, and I suspect that I'm possibly going to give a long-winding answer because there is so much to talk. So feel free to get in between, like a conversation type, if you want to ask something on a follow-up basis or something. So I think the first, like you rightly said, something transformational is happening in the US dollar market globally. Asset allocators are starting to think very differently. And for that, I think the basic background is what's really happening in growth itself and why there is a lot of policy uncertainty. I think uncertainty factor is right now right at the top. And the kind of flip-flops which are happening with respect to tariffs and with respect to so many other things, and foreign policy and financial policy and monetary policy, everything kind of getting intertwined, has led to a huge amount of uncertainty premium in every asset class. And so that impacts every asset class in a very different kind of a way. The first thing that I think we need to know is that I think what tariffs has done is kind of led to a stagflationary scenario where you are going to witness higher price levels and you are going to witness lower growth. Maybe it's not a recession like people felt earlier when it was announced on 2nd of April, the reciprocal tariff, but definitely substantial lower growth, because after that we have seen a lot of pauses and things like that. So the first thing is that we are seeing a lot of soft data coming out weak in the US, where people are starting to give a prediction, or the sentiments are coming very weak, but hard data is still not started coming weak. And add to this the fact that there is a shrinking immigration labor supply, which is expected to kind of hit growth and again hit inflation in the US. You have a policy concoction which is not very macro friendly, I would say, because the exact opposite of it is what every country will want: higher growth and lower inflation. And also add to that the kind of court challenges, which basically means that every time something happens which leads to the tariffs going away, there is a risk on behavior in the market, and every time tariffs come back, there is a risk of behavior. All of this is added to the uncertainty. Now, in addition to the uncertainty, the other thing, the elephant in the room, if I may borrow the same phrase, is we all knew that US was running a very high current account deficit, and we also knew it was running a very high fiscal deficit. So, but then earlier, people were not questioning the US dollar. People were not questioning the sustainability of the US to continue doing this for some more time to come. But what changed in April is the kind of self-reliance on the US that Trump is trying to bring in, if I may use it in a very euphemistically nice jargon, and the fact that everybody else, even their allies, are not allies anymore. So, and the fact that the tax bill is going to lead to a huge amount of increase in fiscal and all that. So what has changed is now people have suddenly figuring out that is dollar and is America something that do we need to necessarily live with, or can we kind of do our own in diversifying away from US assets or even hedging US dollar and so on and so forth. Let me give a little bit of an example in this. So the way in which central banks are positioned currently, Manoj, is that you have the Fed now looking at the uncertainty and looking at the fact that they won't be able to cut rates because growth, even though growth is slowing down, likely to slow down, they also are likely to see inflation going up. And contrast that with Europe or any other UK, for example, you're likely to see rate cuts. And in this kind of a scenario where dollar is likely to, the rates in the dollar environment is going to remain high and the non-dollar environment is going to remain low, you actually would have seen an appreciating dollar. But what you have now seen is a depreciating dollar. And that's the reason I said that there is a kind of a transformation which is happening in the market. And people have started thinking about every investment that they have done in the past also as a potential source of risk if they have not hedged it. So frankly, nobody felt the need to hedge dollar, and dollar was the mother currency, and every other currency needed a hedge. But suddenly you're seeing a scenario where dollar itself needs a hedge. And that's the reason why two things are happening. One is global asset allocators are starting to look outside the US. So incrementally, they want to diversify away from the US. And the second thing is they've started hedging their dollar investments also. So any follow-up from your side? Yeah. Manoj, I can't hear you.
Apologies. So a little new to this. So, 6 months ago, we were talking of a Goldilocks economy. US dollar index was up to 108, 109, now down to below 100. And, all that you said is true. But, that brings me to the $1 million, or should I say like 1 crore rupee question, which is what the traders will ask is, following all this, what's your view on dollar INR? We saw 88, then down to 83, now again edging up almost to 86. And, following possibly, capital flows, FPIs,
Yeah.
etc. But what's your view, for the short to medium term?
Yeah, so I think before I directly come to the dollar INR, let me also talk about very briefly one other development which is also quite significant for global markets, and that is what is happening to the Japanese yen and what is happening to Japanese bond deals. Because what's really happening is that there are 3 or 4 reasons as to why even from a Japanese perspective, the yield curve has really steepened a lot. And one of them is the fact that you're seeing now inflation at more than 2% for nearly 3 years. You're now going to see a Bank of Japan for the first time after a long time starting to unwind its quantitative easing and actually starting to do quantitative tightening. And you are seeing, insurance companies in Japan investing less and less because they just don't have as much collections as they used to have earlier. And if you combine all of this, the 30-year and the 40-year Japanese bond yields are really shooting up through the roof. And the reason I brought it up in the context of a currency view is that what this is also doing to global asset allocators is that, for example, you have a lot of investors whose home ground is Japan, and they have invested in the US treasuries, and then they are getting to see such kind of very attractive yields in their home country. Maybe they shift from US or any other country back to Japan. And what that can do is itself do a little bit of dollar selling, dollar weakening, as well as JPY appreciation. So all of this, what it leads to is that while dollar in the short run, from a global perspective, is still susceptible to what Trump does in terms of policy, the day he relaxes on tariffs, you will see dollar appreciating. But like you rightly said, we have seen a 8 to 10% depreciation in the dollar, which is not reversing in a hurry, even when he goes easy on tariffs over the last 2-3 weeks, whenever he's gone easy. So there is a medium-term depreciation pressure on the dollar, which is picked up. Now, the question to be asked is there any other currency which will take the might of the dollar depreciation and appreciate? Now, you don't have any one single currency. I mean, this has been an age-old problem, Manoj. Euro, JPY, and Swiss franc are the three common currencies which are supposed to, be the alternative from the dollar, but there is no single currency. So my suspicion is, for a medium term, there is going to be a gradual US dollar depreciation that we will see, and the appreciation, or what will take the appreciation pressure, is these three currencies, and maybe gold also to that extent will also benefit. So you have a dollar I would say a gradual depreciating weak dollar in the global perspective. But what does it do to INR is slightly a little bit more interesting territory we are getting into. Because other than the global dollar view, I think what is important for INR is what's happening to INR BOP, the balance of payments, the current account deficit, and all that. And what is RBI going to do with dollar depreciation? And what is going to happen to Chinese yuan, and what's going to happen to the other Asian countries? So I think it's now well understood and well accepted that if other Asian currencies were to depreciate beyond a point, I don't think RBI or it is favorable for us to let the INR appreciate beyond a point. So the first thing is, more important bit than the dollar G3, how it behaves, would be how is dollar Asia moving. Now, if dollar Asia is going to not appreciate as much, or rather dollar does not appreciate as much against the Asian currency, then INR will also need to kind of follow suit. And the third, like I said, is the balance of payments. Now, when you talk about the balance of payments, you have a broadly balanced BOP situation both last year and this year. But the good news is the current account deficit is very much under control. Even when there are concerns on tariffs, we don't expect the current account deficit to exceed 0.6 or 0.7% of GDP. Typically, a run on the domestic currency happens when the country's CAD goes for a toss. That fear we don't have because of the tremendous performance of services, which have been consistently going up month after month, year after year in the last 3-4 years. So the CAD at the overall level is very comfortable. And capital flows are a little fickle. Right now, we are not able to see too much of capital flows. But my suspicion is that in the second half of the year, in fact, most of the global audiences to whom we speak to are all positive on India, but they're not ready to put in the money into India because they want to see the dollar where it is stabilizing. They want to see where tariffs are stabilizing, because you still don't know which country is going to emerge as the cheapest country to produce with this kind of tariff rates. So I think second half of this financial year is when maybe India will start to get some inflows. So in the short term, I believe that the Reserve Bank of India will possibly prevent the INR from appreciating too much in light of the fact that the Asian currencies are not depreciating much. So they will have to, kind of let the INR behave in sync with the Asian countries. And they will, the flows and the dollar weakening globally will lead to a natural appreciation pressure on the INR, but the RBI will prevent it from appreciating. So in other words, I'm kind of giving a range kind of a view in the short term, 84.5 to 86 kind of a view, but we have to closely watch what happens to the dollar vis-a-vis the rest of the currencies.
So that's helpful. And your point particularly about capital flows turning around, because last year, if you recollect reports about FDI having been one of the lowest in many years, and I think that could also possibly be ascribed to a lot of startup investors, etc., cashing out. Possibly, you think?
Yeah, I think the gross FDI numbers are not too bad. It's the net FDI numbers which are so less, and plainly it's because of people who invested through FDI route or through FPI route 5 years ago are now happy to exit it, uh, basically because of the attractive valuation that they are getting. And sometimes you have heard of stories where sometimes subsidiaries of parent MNCs being valued more in India than even the parent being valued
Oh, yeah,
abroad.
absolutely.
So those kind of valuation arbitrages are still there. And so I think the way to look at it is this is going to be a cycle. You're going to see money coming in into fresh startups and fresh investments coming in the primary market, but exits continually happening in the earlier investments that were done. So I guess we might not be able to expect too much of a net FDI flow, while gross FDI flow will continue to come in.
Great. So now let's move on to our topic closer to our hearts, since at heart we are all fixed income guys, right? So
Yeah.
so let's talk about interest rates, and maybe the key drivers for interest rates or interest rate action really is inflation and growth. So let's approach it from growth side first, and we've seen, of course, good. It would be good to have your view on what you see happening to growth going forward, or what has been happening in the recent past, the levers for that, and of course, what do you read out of our the HFIs, like the high
Yeah.
frequency indicators?
Yeah.
Though I must say that because of India, we don't get data that fast. Some of the high frequency indicators globally tend to be longer frequency indicators here. But having said that, what is your take from that? If you can
No, so
elaborate.
I think, yeah, we are meeting just a couple of days after the GDP data came and surprised everybody. GDP data is not a high frequency indicator. It's, of course, a backward looking indicator. But the fact that it is surprised both GVA and GDP was higher than consensus estimate by at least 40 basis points. And 40 basis points is a huge number at the GDP level. So that is the first level. And I think the basic, the things which led to this was the higher government spending, the better construction activity, and the higher manufacturing margins on the supply side. I think these are all were the ones which kind of led. And I think the government has done a fabulous job in Q4, and even as we speak, it continues in April and May in terms of the budgeted, in terms of the capital expenditure that they spend. But like you said, Manoj, the some of the high frequency indicators, like whether you say index of industrial production (IIP), you look at e-way bills,
Power
GST
consumption.
collections. The GST collections are fabulous.
Yeah.
The PMI indicators, while PMI is at a 3-4 month low, it's still much higher than 50. It's at 56, 57 kind of levels. So broadly, they're all coming quite well. And and the reasons for the positivities are, we do expect, I mean, and so what we have done is we are actually in the next year, we were at 6.2% GDP growth for FY26. We have upgraded it recently to 6.4%. And this is post the GDP surprise of Q4. And in addition to the surprise, what we felt were the reasons for the positivity is things like the tax cuts, which the income tax cuts which happened will spur urban demand, good rainfall, which is expected to be close to 105, 106% of the long period average. That augurs well for Kharif crop sowing. That will increase agricultural output and also play a part in increasing rural demand. The lower food inflation also will contribute to higher consumption from the urban side as well. Lower energy prices with oil prices being where it is, even though it has gone up yesterday to 65, 66. But broadly, it's been in the 60 to 65, 60 to 70 kind of range, which does not affect India badly, and also gives a potential for the government to increase excise and raise some revenue. Then also the other positivity is the improving corporate margins in Q4, the construction spending, the railways, roads, bridges, and the domestic travel demand, which is continuing. So all of this are what we look at from a high frequency indicator perspective. And I do think that growth is not falling off like what was feared earlier. I think we have well and truly bottomed out and it's now on the way up. And with RBI having turned around dramatically post December from a monetary policy perspective, and its policy has also started supporting the economy, we are seeing a turnaround. So we do expect growth to do well as we go.
So then, you mentioned RBI, and I think Governor Malhotra has now spent almost 6 months in the saddle. Uh, from the time he came and to now, two rate cuts, uh, market, awash with liquidity. And just before he came, all of us were clamoring that something be done about the liquidity. So I think whatever was could have been expected from a governor who's just come on board, he has more or less delivered. We'll see what he does this coming Friday, and maybe I would like to have your view on that as well. But in light of that, and given that you just mentioned, of course, inflation is another point, right, which is ticking below 4, which has been lesser than RBI's corridor. So there is room now for rates to come down. So in light of that, what's the view on rates, and then what's the view on bonds?
Yeah. So I think first, the policy on Friday, we're going to see a rate cut of 25 basis points. That's my view, our view. And I think there are certain, maybe a very minor minority level of people who are expecting maybe 50 basis points as a surprise. But I'm not very sure about that. So I do think that it's 25 basis point rate cut. And like you rightly said, when you look at inflation for the next 12 months, Manoj, 9 out of the 12 months, we expect inflation to be below 4%. And we expect the entire year's average to be in the region of 3.6 to 3.7%. And this is happening after a long time. We are seeing food inflation at less than 2.5. We are seeing core X gold also in the 3 handle. It's only when you include gold prices, you're getting core inflation at higher than 4%. So net, I think it's a very, very, what should I say, happy prognosis from a macro perspective that inflation is very well contained. Add to this the fact that the external factor, like I spoke about, current account deficit. So there are only two things that the central bank will need to worry about when they're cutting rates. One is inflation and the other is current account deficit. And current account deficit is also well contained. Actually, there is nothing to really fear. And this is one of the reasons why the differential between the Fed rate and the RBI rate has been coming down dramatically, because in the past, when differential comes below a particular tipping point, if the current account deficit was on the higher side, then you will fear that there will be a run on the INR and hence you will not be able to cut rates. This time around, that fear is not there, and that's one of the reasons why we have been able to cut. So if you look at 3.6 or 3.7 as the average inflation, and you look at a 1.5% real rate, I actually think the governor has spoken about a 1.2 to 1.7. So even if you think about a 1.7 real rate, which is at the higher end of the spectrum, you can argue for a 535 or a 540 kind of a repo rate, which is 60 basis points lower. So we believe that they are going to do a 50 basis point rate cut over the next two policies, 25 in June in this Friday and 25 in August. And along with that, they will keep the liquidity surplus. They're already kept the liquidity at a substantial amount of surplus. We are close to 5 lakh crores of surplus from a durable liquidity perspective. But I think this durable liquidity will keep coming down as forward outstandings of RBI keeps maturing.
Yep.
So I feel that they have actually infused much more liquidity than what was possibly necessary in order to take into account this forwards outstanding. But even when it matures, I'm pretty sure that they are targeting a system liquidity surplus in excess of 1% of NDTL, which is excess of 2 lakh crores. Yep. So from that perspective, I think RBI has kept a lot of liquidity and it is likely to keep more liquidity. So what it will do is also keep the interbank rate a little 10 or 15 basis points below what the repo rate is at that particular point of time. So if liquidity continues to be in surplus as much as what it is right now, even if it is a little less than now, and we reach a repo rate of 550, we can reach an interbank rate of 535 or 540. So I think that's where we are headed as of now. Now, the only thing that can make him cut more is if Fed actually cuts this year. And there are views that because of this stagflationary scenario and because of the fact that the Fed has decided to wait, and markets have been consistently reducing its rate cut bet. Initially it was 100, then it came to 75, then it came to 50. Now it's actually less than 50. We actually think that there's a very high possibility of Fed not cutting at all. In which case, a differential will come down to very low of 1.25 to 1%. So there might be limited scope for RBI to cut beyond 5.5. But otherwise, purely from a purely from a domestic perspective, I think you can pretty much go to even 5% of 5 quarter. And to answer your question on bonds, I think, the swap market is already priced in a terminal repo rate of 530. But when it comes to bonds, obviously, when the rate cuts happen, different parts of the curve will react differently. I think the short end is pumped to react a little bit better. It might fall a little bit in terms of yields. So, but the long end, the extreme long end, has two problems. One is insurance companies of late, even in India, have not been buying as much bonds. And the second thing is the fact that the international theme seems to be of the yield curve steepening, whether it's in the US or whether it's in Japan. So from that perspective, it looks like there will be a bull steepening which will happen in India bonds as well. You will see the short end falling as yields keep falling, as repo keeps falling, and the long end not falling as much, but definitely falling as well.
So any level you want to forecast for the 10-year, let's 3 months down the line?
Yeah, so I think by June end, we would be 615 to 630 on the 10-year. So I'm not seeing pretty much move from here. And 610 to 625 over a next 4 to 5 month perspective. And the reason why I'm a little not too aggressive with the 10-year yield going too much lower is only because as repo rate keeps going lower, if market gets certainty of further repo rate cuts even after that, then you can see the yields falling. But if the market feels that 5.5 is pretty much over and done with, then you won't see the 10-year falling more than what I'm anticipating right now. So I think what is important is the kind of message that the governor gives on Friday. Right. If he kinds of gives a very dovish message even after a 25 basis point cut, which gives the impression to the market that maybe 5.5 is not done, maybe it goes to 5/4, then you can see the 10-year bond yield going to 6%.
No, fair. That's a fair answer. So the last question now, Prasanna, is on equities. Equities behavior has pretty much mirrored, and in the truest sense of the term, what has happened on dollar-rupee, right? So, being an old guy, like if you follow Sensex, it went up to 82K or so, 84K, 85, 86K actually. Then down to 72K, and up again to 80, 82K. So this behavior, of course, high volatility, and we know some of the reasons why it went down. But what's your take? How do you expect stock markets to behave? Of course, also a little bit of a word on this rally has still been fairly narrow. Like in terms of not spread out to wider markets. What's your view on equities?
So actually, Manoj, the interesting thing which is happening right now is that it's the Nifty which is not able to rally beyond the levels that we have seen over the last 15 days or 20 days. But you look at the mid-cap index or the small-cap index, we are seeing a lot of good performance happening. It seems to me that we are increasingly getting into a bottoms-up market, a stock pickers market, rather than a macro top-down kind of a trade, which was what it was post-2020 to post-2021. And I think the reason is possibly that market has gone ahead of itself in terms of that markets and earnings growth are not a straight line, or GDP growth is not a straight line. There are a lot of market always discounts it in advance. And then the best case scenario for the market is for it to be stable rather than falling, and then allow the earnings to catch up with valuation. So India is clearly one of the most expensive valued emerging market. There's no doubt on that. And even historically, we've always been overvalued, but even from an historical average overvaluation average perspective, we are overvalued. So that means that maybe at the index level, you will not see as much gains as what you will see in some of the well-performing mid-caps and small caps. And I think the way to look at it would be to look at the sectors which are doing well. You can look at travel, you can look at some specific sectors which are doing well, and then take maybe the top 2 or top 3 companies there if they happen to be mid caps. I think those kind of things I think is what is there. But of course, I have to warn that I'm just a trader and I just run a small equity trading portion, and it's not really a big. I mean, there are much bigger and better players who will give views on equity markets. But having said that, I think corporate earnings this quarter, we are kind of pleasantly surprised. At least the worst did not come through, and there is a little bit of wide outperformance beyond that. Also, the fact that the domestic macros are looking good. Also, the fact that the tariffs are likely to affect India the least. And so, of course, we are all waiting for what is the resting level of the tariff. But definitely, there is the fact that US is against China is very clear. And hence, if it is against China, it will also be against the Vietnams and the other countries of the world through whom a lot of exports were getting routed. So if that is the case, then it's a safe thing to assume that India will be preferred vis-a-vis other countries. So that is also something that, a market is looking favorably. So all in all, and see, the point is domestic flows continue. It's the foreign flows which are being very ephemeral, coming in today, coming out tomorrow, going out tomorrow, and things like that. So we have to wait and watch. I suspect that second half of this financial year might be a better year for equity markets than this first half. Manoj, you're on mute again.
Oh, sorry. On a lighter note for the equity traders, at least they don't have to worry about the equivalent of a taco trade. We don't have like a vada pav trade or something here.
No, but the taco trade is what is kind of making the volatility higher. So while Indian VIX has come down, I think overall volatility, you just have to look at what kind of news items comes out in the morning and how US reacts. But then if you see actually in the last few weeks, the correlation between US equity markets and Indian equity markets is not there.
That's true.
We are, I think, going on our own.
Absolutely. And even the volatility in the US has reduced as the taco is discounted.
Discounted. Yeah. Actually, that's an interesting thing. Yeah. People are now assuming even if he announces a 50% tariff, he will go back on it after some time. So they're not reacting to the negatives.
Absolutely. I think that's a good idea. Anyway, Prasanna, that's it from my side. You have anything specific you want to talk about or shed some light? Or
No, Manoj, I think we covered pretty much. In fact, I think we were supposed to do a 15 to 20 minute interview. Looks like it's gone up to almost 30 minutes. So I won't add on to it. Like you said, investor attention is very short focus. We should give out short videos rather than long.
Anyway,
but thanks very much for having me, and it was a lovely chatting with you.
No, that's what I'm saying. So long as you had fun and I had fun, I think we've achieved our objective. Thanks a lot, Prasanna, and look forward to have you back later. Cheers.
Sure.
Thank you.
Thank you.